Have you ever felt like you're just not getting the real story behind a company? You see the headlines, but there's more to it. Well, today we're putting on our detective hats. We're going to look past all that noise and dig into the hard evidence, a company's financial statements, to find out what's really going on. So let's start the investigation. So here's our game plan. First, we'll get our detective kit ready. Then we'll start decoding the balance sheet to find our first pieces of evidence. After that, we look for clues in financial ratios, figure out what the market is thinking, and then, the best part, we'll connect all those clues to spot the red flags before delivering our final verdict. All right, before we just dive headfirst into a company's books, we need to make sure we have the right tools for the job. Every great detective relies on a few key tools to tell the difference between fact and fiction. Let's open up the kit. So that's the real question, isn't it? How do we get past the hype? The headlines can tell you one thing, but the financial statements, well, they don't lie. They tell the real story, but you've got to know how to read them. You have to speak their language. Our whole investigation really comes down to these two key pieces of evidence. On one hand, you've got the balance sheet. Think of it as a photograph, a snapshot in time. It's the hard facts of what a company owns and what it owes, period. Then you've got the PE ratio. And that's all about what people think. It measures what investors believe the company's future looks like. So one is reality, the other is all about expectation. First up, let's crack open the balance sheet. It's sometimes called the Statement of Financial Position. And this document, this is ground zero. This is where we find out what a company is truly worth, right here, right now. The easiest way to understand a balance sheet is to realize it works just like your own money. It's really that simple. It just comes down to what you own, what you owe, and what's left over. If you get that, you can understand the balance sheet of pretty much any company on the planet. And that brings us to the absolute golden rule of accounting. Assets have to equal liabilities plus shareholders' equity. It has to balance always. Just think about it for a sec. Everything a company owns was paid for with one of two things, either borrowed money, which is a liability, or the owner's own cash, which is equity. That's it. So those two sides of the scale, they have to be equal. Okay, let's look at the asset side first. This is basically the company's treasure chest. It's split into two parts. You got current assets, stuff that's going to turn into cash pretty soon, within a year. We're talking about actual cash, inventory they're about to sell, or money their customers owe them. And then you have the non-current assets. These are the big, long-term things that keep the business going, like their factories, their equipment, or really valuable patents. Now, for the other side of that coin, what the company owes. These are its liabilities, kind of like its financial anchors. And just like with assets, we split them up. There are current liabilities. These are the bills that are due within a year, like paying their suppliers. And then there are non-current liabilities, which are the long-term debts, like a big loan on a factory or corporate bonds that they won't have to pay back for years and years. Okay, so just looking at the raw numbers on a balance sheet is one thing, but to be a real detective, we've got to do some forensic analysis. This is where we use financial ratios to turn all those numbers into actual meaningful clues about a company's health. We're going to focus on two really critical questions here. First, liquidity. Can the company actually pay its bills this month? And second, leverage. Is this company built on a solid foundation of its own money, or is it being propped up by a giant mountain of debt? First up, the current ratio. It's a really simple but powerful health check. You just take the current assets and divide them by the current liabilities. If that number is above 1, it means the company has enough short-term cash to cover its short-term bills. It's like our first line of defense for spotting immediate financial trouble. Next, we check for risk with the debt-to-equity ratio. This tells us how much the company is leaning on borrowed money compared to its own capital. And here's the key thing to remember. A high DE ratio means the company's heavily leveraged, which basically just amplifies everything. When things are good, profits can shoot through the roof. But if things go bad, those debt payments can sink the whole ship. So let's look at a real-world example. On its recent balance sheet, Walmart had a debt-to-equity ratio of 1.68. So what does that actually mean? Well, it means for every single dollar of its own money, it was using about $1.68 of borrowed money. That one number tells you so much about its financial strategy. All right, we've done our internal investigation. We've looked inside the company. Now let's step outside and see what everyone else is thinking. This is where we gauge the market's mood with our second big tool, the PE ratio. This quote just nails it. The price-to-earnings ratio isn't about what a company is worth today. It's a bet on the future. It literally tells you how many dollars investors are willing to fork over right now for just one single dollar of that company's profit. So how do you figure it out? It's pretty simple. You just take the stock's current price and divide it by its annual earnings per share. A high PE usually means investors are really excited and they're expecting some big growth. A low PE could mean they're not so sure. Or, hey, maybe, just maybe, it's an undiscovered gem. Now, a good detective always knows there are two versions of this clue. There's the trailing PE, which uses earnings the company has already made. It's based on hard facts, what's in the rearview mirror. But then there's the forward PE, which uses analyst predictions of what they think the company will earn. It gives you a sense of where things might be headed. But you always have to remember, predictions can be really wrong. Now listen up, because this is the #1 rule for using the PE ratio. Context is everything. There's no such thing as a good PE number. A PE of 30 might be an absolute bargain for a fast-growing tech company, but it could be wildly overpriced for a slow, steady utility company. You always have to compare it, both to the company's own history and to its direct competitors. Okay, detectives, this is the moment. We've got our clues from the balance sheet. Those are the hard facts. And we have the clues from the market sentiment. That's the expectation. Now it is time to put it all together, build our case, and hunt for those red flags. So here is the classic mistake that every rookie detective makes. It's called the value trap. You find a stock with a super low PE ratio and you think, yes, I've struck gold. But you gotta be careful. Sometimes a stock is cheap for a very good reason, because the company has deep problems and the market already knows its profits are about to fall off a cliff. So let's pull all of this together into a final checklist. If you see a high debt-to-equity ratio, that's a sign of high risk. If the current ratio dips below 1, the company could be headed for a liquidity crisis. It literally might not be able to pay its immediate bills. What about negative retained earnings? Well, that's the total of all past profits and losses, and if it's negative, it means the company has a long history of losing money. And finally, an excessively high PE ratio compared to its peers could mean the stock is just in a bubble, dangerously overvalued. These are the big red flags you're looking for. We've examined the evidence, we've connected the clues, and we have identified the red flags. So now, it's time for the final verdict, the keynotes that every financial detective should take away from this case. Just remember, the balance sheet and the PE ratio, they aren't just a bunch of numbers on a page. They are storytelling tools. They tell a compelling story of either stability or risk, of proven history or just hopeful futures. You now have the detective's kit to go out and read those stories for yourself. The only question left is, what story will you uncover next?